Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello and welcome to this episode of the Australian Retirement Podcast. My name is Owen Rask and joining me today is Drew Meredith of Wattle Partners. How you going, mate?
Very good. Good to be here.
Stepping in for James O'Reilly, who...
I'm going to say you look a bit different this week.
Yeah. James is aged and they've got me in. No, so for those of you that don't know me, Drew and I co-host the Australian Investors Podcast and James is away this week. So I'm filling in for him and Drew and James will be back next week to continue the 10-part series that is starting off the Australian Retirement Podcast. And today, Drew, we are talking about 10 behavioural mistakes that people make in the lead up to retirement or in retirement itself. And these 10 things, you've got some really good examples of clients that have presented to you.
Yeah, I think there's a tendency to look at behavioural psychology or behavioural finance, which I know you've interviewed quite a few people on, to look at it from this complex perspective that, you know, it doesn't apply to us or everyone talks about it and how it impacts decisions, but very few are able to put it into words or experiences. And that's kind of one of the privileges we have as being advisors. We've met hundreds of families over close to 20 years, still holding on to not quite 20 years. And we see this in action every day. And for us, I think maybe hopefully part of this is also how to deal with those when those biases come up and how we've dealt with them with different clients, different investors over that period. Incredibly exciting and incredibly interesting we always say that most of our job as an advisor is dealing with the emotional and behavioural side of retirement, not just investments.
Professor Daniel Kahneman, who wrote the book Thinking Fast and Slow, I've heard of quite a few interviews with him over the years, and he won the Nobel Prize in finance effectively, but it was behavioural psychology is his focus. He often says that the best we can do or the best we can be is aware of the biases. We can't stamp them out completely because that's human nature. And I think that applies for this episode because we're talking about these 10 things and we will all recognize at least some of these things in ourselves and the way we think about finance, investing, money, the finance profession, retirement, generally speaking. And so the best we can be is be aware of them. So hopefully by the end of this episode, you are aware of some of the common mistakes that people make as a result of this thing called behavioural finance.
It can hold you back and be quite costly, as we'll go through in many different ways, whether it's the ability to get advice or the ability to act on it. We always talk about that analysis paralysis by analysis, but it can hold you back in multiple ways, and we'll hopefully look at it not just in terms of investments, but in the seeking of advice and putting structures in place.
So the first one of 10 is immediacy. Tell us a bit about this.
I think we talked about before the show about recency bias, which is kind of extrapolating short-term events into the future. So, markets have done incredibly well. We expect them to do 25% again next year. So it's slightly different to that. Immediacy bias, in my experience, is people coming in and looking for the solution that works today, but not necessarily thinking about what they need or what's best for the next 20, 30 or 40 years. Most advisors, or every advisor now, has an obligation to think about the long-term implications of their advice. And whether you're getting advice or whether you're not getting advice, you really, and this is probably tilting to the investment side, you need to consider both your short-term objectives. For a lot of people, that's income, but also the long-term objectives. And we essentially think it's a combination of income and growth when you're building portfolios and transitioning into retirement.
This is really interesting because a lot of people do think, well, I'll just have a term deposit. It offers me 5% down.
Sugar hit.
Yeah, and it seems really good. I mean, yeah, sure, you might have to factor in that thing called inflation, which leaves you with 1%. And then in 2 or 3 or 4 or 5 years, your money hasn't grown like a diversified portfolio has. So you're taking a lot of the immediate sugar hit, but what you're really giving up is 4, 5, 10 years from now.
And you see it from the investment perspective as well, where a lot of people, I think we talked about it recently on the Investors Podcast, where you look for the highest yielding investment, you get a nice sugar hit in terms of a 10% yield, but in a lot of the time, and it's the case in multiple asset classes, you're giving up the prospect of growth, or there's generally something wrong with that investment, and you're taking that quick hit in return for a depreciating asset or something that doesn't perform in the longer term. And we know most people in retirement, considering retirement, I still have 20 to 30 years. I've been questioned about 30 years at the top end of the spectrum before. But you need to be, every decision you make now is going to impact the lifestyle you have in retirement, and, investments are part of it. But being aware and being able to balance both of those, and not just thinking about what's going to deliver the best outcome in the shortest period of time.
The next one is anchoring, which is a very common bias that I see with investors, but this could be applied in almost any way to our lives, generally speaking, our financial lives as well as our investments. How do you think about anchoring?
I think starting with the investment side is that there's so many people, and this is whether we've recommended the investment for someone or they've held an investment themselves, but they anchor themselves to the original price they paid for something. So if we talk about companies like Magellan or AMP that have done incredibly poorly, it's more of an investors podcast topic. But people find an inability, and this will relate to another bias we're talking about on here, an inability to take action on that. So they'll be anchored to this idea that they need the share price to go back to this certain level before they'll act on that decision. So they're stopping themselves from making what would be positive decisions because of this attachment to an arbitrary figure. And it's probably even more evidence for us in every person or family we work with inherently has a number in their head that they want their portfolio to be valued at. But the entire nature, and if it's below that, they're stressed. If it's above that, they're happy. But the entire nature of retirement and superannuation is that you're expected to draw down your money over your retirement. So the value of your portfolio should fall, and the value of your assets should fall because you're spending it. But anchoring to that figure can essentially make you make bad decisions and uninformed, or again, kind of short-term rather than long-term decisions.
It's quite interesting because a lot of the commentary that's come out over the last few years about super is that people are dying with more than they're retiring with because they're so scared of spending money that they end up with more, which is quite interesting. But then there's this other growing chorus that seems to suggest, well, the kids they've got enough, they're fine. I'm going to spend it all. Die with Zero is the very popular book from the last few years.
Or spend the kids' inheritance. So going skiing, but not with the actual snow.
One final thing about anchoring before we move on to the next one is it doesn't have to just be a point in time, a price or something like this. People can also anchor to negative experiences.
Yeah.
Like a poor experience with a financial planner in the past. Now that's representative of seeing a financial planner in the future. So people hang on to that bad experience, even though the industry's got a lot better over the past few years.
Or an asset class, a bad experience with a managed fund, a bad experience with an ETF, a bad experience with a property trust. There's been a lot of, tax-driven issues in some investments. So it isn't a part of our, the way we try and get over those issues is via a lot of education and probably being more transparent and detailed than we need to be. When we're putting forward strategies or talking about investments, we'll always provide far more detail and analysis than sometimes it can be confusing. But I think information is the key to overcoming anchoring bias, and particularly around understanding the opportunity cost. So what you could be doing with the money or the decision, or what you could be getting if you are able to let go.
Yeah. The next one is bandwagon effect, Drew.
I mean, we love this one, don't we? It's
we've all fallen prey to this one a few times.
There's a rant on the Wattle page, I think, about bandwagon effect, and a lot of this is driven by the financial media, which we're probably part of. Hopefully, we don't contribute to it. But as the name says, it's like the tip from the taxi driver, and it doesn't just apply to investments, but it's as people go into retirement, there's a tendency to talk about. And we know people only talk about their good investments. If you're at a barbecue, someone will be talking about, there's many themes from the last few years: crypto, artificial intelligence, lithium, semiconductors, the metaverse. I thought throw that one in there. I thought that was a good one. And it's this idea that it's this get rich quick idea, or that there's a very simple solution, or that, it's about chasing the next hot thing. So I'm going to make great returns and I won't have to work. I won't have to worry about my retirement anymore. And the entire system is built up to essentially, big marketing budgets, the ability to issue topical and thematic products at the right time. I think it's always, we're always about how do you overcome it, and that's about having frameworks in place to make sure you're not subject to or always falling into the next hot thing. But bandwagon can be incredibly dangerous, because a lot of the time, by the time it's in the headlines, a lot of the returns have been achieved, and then you end up on the other side of it when returns start to struggle, or it's not the hot thing anymore and something else has replaced it.
One of my first ever interviews was with a guy called Charlie Aiken, who was a famous stockbroker.
So you're going to say Charles Munger.
Oh, imagine.
Well, that would have
been. And Charlie was a very prolific stockbroker, very well known, probably the most well known stockbroker in the country, having backed Fortescue and different types of businesses over the years. And when I interviewed him, he said there was this theory that we used to work with, which was the Herald effect. And basically the idea is once the news was in the Herald, it's too late. And
the Sydney.
Yeah, the Sydney Morning Herald, not necessarily.
Not the Herald Sun.
Not the Herald Sun, although probably by the time it's in there, it would definitely be too late. But I remember a few years ago, a lot of retirees, which is really concerning to me, were loading up on cryptocurrencies because they thought, well, this is the next thing. Kids are talking about it. Everyone's talking about it. Seems great. And at the same time, they had this need for income. But obviously, cryptocurrency doesn't produce income. It's widely speculative. So it was two competing interests, yet they jumped on the bandwagon just because everyone else was talking about it. And it really left a lot of them in a sticky place. Another thing which I might quickly dive into, Drew, is this idea of familiarity bias. We see this a lot of the time with people that go to see a financial advisor and they are reluctant to accept something new, a different type of investment, perhaps because they're so familiar with a way that they've done before. I only do this, I only do that.
And advisors aren't always great at either. They can, some advisors only do it a certain way as well. I'd love to understand more on the familiarity.
Well, I find this because a lot of our younger community deal in ETFs and want to invest in ETFs. I find that there's still a very significant proportion of the older population who are resistant to exchange traded funds or ETFs.
Yeah.
And there have been many reasons for that. One is that ETFs seem to be more robotic in nature, the way they're algorithmic. They kind of just match the index. Whereas they're traditionally used to fund managers in a suit telling them something, or maybe direct shares like BHP, CSL. These are the things that have done well for them. And they're not as familiar with these other newer concepts.
To bring new concepts, yeah.
Yeah, even if 2 million people have now invested in ETFs in Australia, it's still new to them.
I mean, BlackRock just hit $11.5 trillion in US dollars.
Yeah, but see this, and that's the kind of the thing is we like things that are familiar to us. They feel comfortable to us, and I bet when you get retirement clients come to you at Wattle that a lot of them have shares in their portfolio, BHP, CSL, CBAs. It doesn't make sense to sell them from their portfolios. Rather just absorb them into your strategy.
Yeah, I think it would also flow over into something like property. And the number of, we're meeting a lot of people that have 1 to multiple investment properties. And there's a familiarity bias with that. Hopefully I can pronounce it properly. And it's this idea of just continuing to invest in what you know and never challenging it. And then I think a big part of retirement and financial literacy hasn't been great in Australia is expanding knowledge base among the alternatives. And I know Warren Buffett's quoted for a lot of things, and I'm assuming this was him as well. But it's this idea of, you don't invest in something or don't do something if you don't fully understand it. And I think we're both of the opposite, which is, yes, overly complicated things don't necessarily make sense, but it should be your role or your objective to familiarize yourself and educate yourself on areas that you don't understand, because you end up being incredibly narrow and likely missing out on things. And probably one of them is probably relates less to investments and more to the experience of retirement. This idea that most people are familiar with accumulating money. So constantly you're seeing your balances go up. You pay down your mortgage and you're seeing your balance constantly go up. When you get to retirement, it's the opposite. You've got a finite pool of capital, and now you could see your portfolio move as much in a day as you earned in a year in the past. Incredibly unfamiliar territory. And it's exactly the same for being familiar with you're always having an active income. Your paycheck's always coming. When you shift to passive income, you don't know. The dividends could be cut. And basically it's almost a leap of faith in understanding that what you're putting together is a source of income that will replace your active income and do so for a long period of time. But you have to be comfortable. Otherwise, you end up watching your bank account every day and becoming obsessed with what's happening in investments. Incredibly uncomfortable.
A lot of people do that when they first turn off the income and they move into, say, 65 years old. They've just turned on to the pension mode.
Terrifying.
And let's say, hypothetically, the couple has $1 million in their super, and they see that their super's gone up, say, 7 or 8%. In, say, a few months, there's some sort of volatility. They would think to themselves, we had to work a year for that amount of money, and now that's just happened in 3 months. But it can be the opposite as well. And that's terrifying for a lot of people. So they're totally unfamiliar with that.
Particularly those without experience. So it's about, showing that experience. And one, for a big part is actually when you get to that retirement point, making sure you're slowly stepping into whatever you're doing with that capital, if it's investing, whatever it's investing into. So you have the most streamlined experience rather than a bad experience at the beginning that sets you on to another direction.
I often say for younger or newer investors, don't have to be young, that investing is a 3-year apprenticeship.
Yeah.
And then you qualify to understand a bit more and you experience it. But I see a lot of people that hit retirement age and it's their first time experiencing investing.
Yeah.
The earlier you can get some runs.
Time.
Yeah. You got the biggest balance. It's most important to you. And that's why I always advocate for getting advice at retirement, even if you've been doing it for a while. It is so important. And versus hopefully your balance of super or property or your assets, it's the most affordable relative to that as well. So it's worth it.
And even you think if you've got $1 million in super or in assets and the market, on average, I think it goes down between 8 to 10% once every 4 to 5 years, a diversified portfolio, that's $80,000 that you see gone. Yeah. In a year. Sometimes that happens in 2 weeks, and it stays that way for a year. So incredibly uncomfortable dealing with that.
Absolutely. The next one is cognitive dissonance, Drew, which sounds a bit like an insult.
This one comes out of a textbook. I think it's harder. It's much more related to less investments and more about, in my experience, the things that are holding people back when they get advice. The amount of conversations we have, it'll be, I've had a bad experience with super, or I've had a bad experience with an advisor. I've had a bad experience with SMSFs. All my friends talk about SMSFs being too complicated, or why would I lock up super? I'm probably ranting all of these kind of things. But it's this idea that at some point, someone's had a bad experience, whether it was them or their friend, and they've got an inability to overcome that experience, and it's holding them back from making decisions that would be net positive or be extremely positive for them over a long period of time. You can imagine, and I blame the industry. I'm happy to throw blame around. I'm trying to be more opinionated, but blame the industry for a lack of kind of communication and marketing and education to the masses, that things like super and SMSFs are not something to be scared of. They're all incredibly straightforward to a point. And it's for us, a lot of our work is in breaking down those long-held beliefs and ensuring we're finding outcomes best suited to each person.
Yeah. Next one is the Dunning-Krueger effect.
This is one of your favorites.
Which is, you've got in the notes here.
I'm a great driver.
Overstate our abilities and assume so much of it was skill.
I told you, I think I'm the best driver in Australia.
Yeah, well, we're all above average.
It's not good at parking out.
So is that what this is talking about?
Yeah. So we talk, I think you do a lot of interviews with fund managers, professional investors, and even I think they all talk about it as well. And you mentioned that it's all about attribution. But it's this idea, it could be a stock, it could be any sort of decision. It could be an investment decision, it could be a lifestyle decision. And it's this, you're mistaking a good experience. Maybe you made an investment or you got advice and it turned out incredibly well in a short period of time. And you're assuming that you did that all from your own skill and experience. Yeah. And it's probably is the Michael Jordan effect. It's like 40,000 hours before you do something proficiently. And it's just it's almost, I think it links to overconfidence. I think it's slightly different bias, but if you believe that what you do is so good, and investing, it's easy. You could make 3 times on some things without doing much research.
Well, yeah.
It is difficult to overcome. So if we're talking to someone that's done incredibly well picking mining companies, it's hard to convince them not to pick mining companies, whether it was luck or skill.
Absolutely. over on our Australian Investors podcast, you've talked about the FANG Plus ETF from GlobalX. This is an ETF that just invests in the top US technology companies.
I put this in, yeah.
And this is from full disclosure, GlobalX is a sponsor of our Australian Investors podcast. And that investment has done very well for you.
Yeah.
And the question then naturally becomes, was that luck or was that skill?
It was luck.
Okay. But that is a very fair and reasonable thing.
Timing was luck, yeah.
How do we determine what was luck, what was skill? You ask property investors or people that own property, was buying a property 20 years ago luck, or was it skill, or was it something else?
Or was it interest rates?
Or was it, was that the right street at the right time?
Yeah.
Were you aware of planning regulations that would change for your favor or go against you?
We feel like we control these outcomes, but we don't. Yeah.
Annie Duke, in her book, How to Decide, she's a famous poker player. She has this term called resulting, which is we judge the quality of our decision-making based on the results.
Yeah.
It's kind of like...
We don't measure it until we get the result we want.
Philosophical. It's kind of like consequentialism, where what you decide, your decision and the appropriateness of that decision was actually based on the consequence. And a good example of this is you buy a stock, it goes up.
Yeah.
Was that a good decision?
Yeah, 100%.
Yeah. But it could have been luck, right? And so it's very hard to know.
Particularly on any given day. And you apply Dunning-Krueger on a daily basis and you could see your stock doing well for a week and you assume it's because you timed your purchase so well.
Yeah.
But do you do the same when it goes down in that same week?
It could be
definitely not.
It could be relocating. Like a lot of people in retirement, they sell their house. They would have done that in the last few years. Property price has been really resilient. Was the fact that you sold in the past couple of years and downsized, was that because interest rates...
You saw it coming?
Yeah, you thought that was going to happen? Or was it just because it was a lifestyle decision? So you have to be very careful about then how do you relate that to your belief about property and how you do property. That's just where that kind of common sense self-reflection comes in. So the next one, speaking of kind of what you own and why you own it, which is this idea of endowment bias. Talk us through this, Drew.
I'm skeptical. I'm trying to avoid doing too much on investments and stocks. Naturally, that's where a lot of it leads with these biases. So endowment is essentially something you value something you own more than something you can replace it with or purchase or trade it for. So you can start with something like a property or an investment property where you own a property, it's done incredibly well over a period of time, but it's clearly got issue. The roof's falling off, it needs another 30 grand in renovations, and you're unwilling or you're so attached to it because of that endowment effect that you can't see that you could put the same money into a term deposit next to it. And the same comes with, on a investment level, long-held stocks in Australia. A lot of the people we meet have inherited CSL or CBA or BHP, or they were lucky enough to buy it. And to convince them, a lot of people, to sell holdings that one, have done well, but two, were passed on by, in a lot of cases, family. It's like one of those, it's probably negative, but it's like out of my cold, dark hands, will you get me to sell any portion of it? And on that side, one of the biggest impacts can be not only will they not sell it completely, but they won't even sell a portion of it. And a lot of people have, particularly in property, you can have 30% of your retirement assets in one asset or more. And an inability to take any action on that can be incredibly costly because you're tying your performance and your lifestyle to one investment or asset.
Yeah, the number one endowment bias that I see is parents and grandparents thinking that their grandchildren or children are the best, and everyone else that has grandkids or kids.
Mine are pretty cute.
Yeah, see, you're very cute. I have to say that, Drew, because you're in front of me. But that's an example of endowment bias. Mine is better for whatever reason, just because I have it.
Yeah.
And the key thing with this is that the way you can navigate this idea is by getting an objective person in the room, particularly if you're in a relationship, you're transitioning to retirement. The financial advisor comes in as an objective observer and can give you researched and an elevated understanding of finance to be like, well, I can hear what you're saying, and that's the emotional side potentially speaking. Here's my third party take on this. And as a client, it's about being open-minded to the challenge that might come, because we often say this, right? You can't will something to happen in finance, just because you believe it doesn't mean it's going to be a good outcome.
And in a lot of cases, members of the couple don't agree on these things. One has endowment bias and the other one doesn't. Yeah. So I'm in the middle of several conversations at the moment, which is, and again, how do you get through it is via data and, modeling and showing options of what either outcome looks like.
Yeah.
But it's completely common, and it's not always, as a couple or a family, but between family members too.
We've got 3 left, Drew. This next one is very, very popular. I mentioned Daniel Kahneman at the top of the show, one of the proponents of this, which is called loss aversion bias, which is basically it's the tendency for humans to feel the pain of loss more than the joy of gain.
Yeah.
And we see this play out time and time again when it comes to money.
Yeah, and it can range from super funds to ETFs to themes, which we talked about before, and to stocks. We just hate admitting that we've done something wrong, to be honest. You can't really apologize to yourself too many times. So this to us is probably one of the biggest challenges we have in keeping and getting the most for clients over the long term, is whether we've recommended it or they've recommended something. The role of an advisor is to be objective, and if there is a significantly better outcome from doing an alternate strategy. Again, it could be you bought a property within the last 2 to 3 years, interest rates have gone up and it's in Melbourne or Sydney, but we know the other property markets have done well, and an inability to let go of that and see that it's costing you money. You'll have a better experience. You'll have more flexibility for you to do something else with it. And it's just anchoring to that value, but also not being able to let go. And I think not being able to measure the opportunity cost of what you're doing.
Yeah. It's good, interesting. If we use an example of, say, $500,000 that you have in super or for your retirement, imagine for a moment that you lost $100,000. So now you've got $400,000.
Yeah.
That would be devastating for a lot of people. That would be completely devastating for people in their retirement years.
And assume it's going to come back.
But imagine that it goes to $600,000.
Yeah.
You think, oh, yeah, that's pretty good.
Yeah.
But the feeling of good is nowhere near as powerful as the feeling of dread. And you feel way worse for that. And according to Kahneman and Tversky, it's depending on
you're more likely
the
to
math,
make
it's 2 to 3
decisions.
times. You feel more likely. And you see this with retirees a lot, is one of the couple is very much, let's build a diversified portfolio. The other one who has a more pragmatic mindset, which is built on, I work hard, I make money. I work hard, I make money. If you have that kind of mindset, you're less likely to invest because you don't understand investing. You don't understand that there are bad years, but there are also good years that outweigh the bad years. And so this bias is very strong, I find.
And for us, it's all about how do you build resiliency into a portfolio to the point that you're not afraid of realizing those, like, losses will always come. If everything's doing well at the same time, you're not really diversified. So how do you make sure that portfolio of assets that are funding your income are resilient to significant losses? Because we know that's when bad decisions are made.
Yeah. So we've got 2 more left. This one is that, and this is your words in the notes here, Drew. It says size is what matters.
Very much.
So what is this bias or this mistake?
This isn't this is more a personal philosophical bias rather than one that comes from maybe, I'm sure there's one that links to it. We did do some research on a website that had about 150 different biases. But this has been a problem in the industry and in financial services for probably 20 or 30 years, which is this assumption that bigger is better. So you can, because it's big, because it's backed by a big insurance company, a big bank, that they're trustworthy, they'll do the best, they'll get the best returns, can be applied to industry funds, can apply to financial advisors, can apply to products. And that assumption is, we know it's completely wrong.
Hello, Royal Commission.
Exactly. So it's just understanding, being, I think I like to use the word or the terms healthy skepticism, have healthy skepticism towards anything. I spend a lot of time either justifying or walking clients through all kinds of issues and questions. And I think the issue with being bigger is that you start to become a number at the other end of it, but also there's a tendency as things get bigger to focus more about relative and how they're doing relative to other groups, or how they grow in their own business, as opposed to absolute returns and the best returns or the best outcomes for each individual client.
I think we talked about this a lot. Individual financial planners, I would definitely go with someone who's not part of one of these massive firms. Like, say, for example, Wattle, it's owned by you and Jamie.
Yeah.
Northeast is owned by James.
Yeah.
I prefer personal accountability rather than corporate accountability. I think you just get lost in this maze of who's ultimately responsible, and you just get passed from door to door to door if something goes wrong. But, more boutique financial advice firm with their own license, for example, you know who's responsible. And that gives me a much greater level of comfort than just being part of a big building. Final one is, if size is what matters to some people, cost is what matters to a lot of people. How do you think about this?
I can't remember who quoted this. I'm not sure if this is, but I don't think it's Warren Buffett that was quoted as it. It's definitely someone else. And there's two sayings, which is show me the incentive and I'll show you the outcome.
That's Charlie Munger.
Yeah, that's Munger, definitely. And the other one is if a product is incredibly low cost or free, you're usually the product. So costs definitely matter. And one of our golden rules is around keeping costs under control. But it's incredibly important not to, you can reduce costs to a point, but at some point you're giving up a significant amount of either benefit or value. So for us, it's all about keeping the costs that you can control to a minimum level, but ensuring that you've got the ability to navigate different experiences, different environments, and understanding that if you're paying nothing, you're essentially going to get the average. And for us, more broadly, and I think in retirement, you generally need more than the average. You're now, or at least a better experience than the average, and that tilts towards the investment kind of line as well.
My granddad was a big fan of saying, if you pay peanuts, you get monkeys. And I kind of agree with that in many respects.
Usually there's hidden biases or some sort of hidden fees in there as well.
Yeah. In my world, dealing with younger families and people growing their wealth, what I find is that the cheapest platforms, the cheapest investment services are often the most concerning. They monetize their business in a way that you do not want to be part of. For example, a lot of brokers will offer free trading of like ETFs. You can buy $1,000 of ETFs, but what they are doing on the side is they're offering CFDs or contracts for difference to the other communities, and that funds that, and that's a horrible thing for people that aren't aware. Or, for example,
that was the outcome of Robinhood, wasn't it, back in the pandemic,
COVID times?
Yeah, Kitty.
Yeah, there was a lot of things that went wrong. And so I think for some aspects, that it's right to say that fees are one of the few things you can control in finance. So you should consider them, as you say, but don't overweight that.
Yeah.
I cannot stress that enough. And I think what I find, Drew, is that younger people who maybe read great books like Barefoot Investor and those types of wonderful books, they're very fee conscious, and that is totally fine. But as we evolve over the next 20 or 30 years in financial markets, I actually think that there is a point to that, and there is a limit to that. Too much, and could be a very costly mistake. And that's where, and then when it comes to getting advice, I don't want the cheapest accountant. I don't want the cheapest financial advisor. I don't want the cheapest doctor. I do not want the cheapest of anything. I just do not want that in my life.
Yeah.
And it's obvious why.
Yeah, and it goes well beyond investments. I think that's the key. And it's easy. I think one of the issues you can see in financial advice, so we're very much on, there's three types of fees. Which ones can you control? There's admin fees, there's advice fees, and there's investment fees. You can control admin. You can control as a client, all of them, but which ones do you want to prioritize and which ones do you get the most value from?
Good point. So just to recap these biases or mistakes, we'll call them. Immediacy, which is here and now. Anchoring, price, previous experience. Bandwagon effect is if you buy something that's just because everyone else has bought it, it's gone up. Cognitive dissonance. Drew, what was this one?
This was an inability to overcome previous beliefs. So you've had a bad experience, or your understanding of using super is jaded by conversations you've had in the past.
Dunning-Krueger. Overstating our abilities. Was it luck? Was it skill?
I'm a great driver.
Yes, you are. Endowment. Drew's kids are lovely. I can say that for sure. That's endowment bias.
I have the best kids.
He has the best kids. Loss aversion bias. We feel the pain of loss or even expected loss more than a gain. Size is what matters. The Royal Commission proved that maybe not.
Yeah. Just because it's bigger doesn't mean you should trust it or rely on it for the best outcome.
Costs are all that matter.
that if you pay peanuts, you get monkeys.
Yeah,
it's probably the simplest way to talk about that one.
And finally, familiarity bias, Drew.
Just an inability, it's an inability to adjust to changing conditions. So you get used to doing one thing and to switch that off. Work is the perfect example.
That's the 10 behavioural mistakes that people often fall prey to. If you do have some of your own, I know a lot of the Australian retirement podcast community is taking to YouTube. Let us know your feedback. Which of these biases may have applied to you? You can also get in contact with us via the community, which people are using more and more and more. And finally, Drew from Wattle Partners, James O'Reilly from Northeast Wealth. You can get in contact with them by using the link that is in the YouTube description or the description in your podcast player that says financial planning. You can click that link and you'll be asked some questions and you'll be matched and able to book in with Drew or James's team and hear from the guys directly. So, mate, we're going to resume regular programming with James next week. For anyone that is new to the Australian Retirement Podcast, we are doing 10 essential episodes. And after that, there will be questions, guests, interviews, everything that you want. We need your feedback and we love hearing from you. There is a link in your YouTube descriptions on your YouTube player or on your podcast player that says ask a question. You can use that to give us feedback. The guys are getting a lot of feedback and it's been really positive. Some really constructive feedback as well, we could say, Drew, which is good. It's exactly what we want. These two are financial professionals.
We're trawling the community, looking for questions all the time and then taking it from our own day jobs at the same time and trying to hopefully bring insightful and questions that lots of people are asking.
So we will have a lot of questions after episode 10, one episode a week. You can subscribe. It's free. There are heaps of resources. Just get in contact with the team and we would love to hear from you. So Drew Meredith from Wattle Partners, thanks for joining me.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.